Hi folks, Chuck Gibson from Financial Perspectives with the second quarter 2019's Charts on the Move video. What a difference a quarter can make. Last quarter's video showed stocks were in a consolidative, non-directional mess. While we're not out of the woods quite yet, long-term models have provided a buy signal and we're seeing global risk appetite increasing. Let's jump into the charts and show you what has me all fired up. Before I do that, because I had an inquiry about a sector rotation, I want to show an example of what I mean. Sector rotation is nothing more than the movement of money from one industry sector to another. For example, when investors are afraid, money tends to move out of momentum and high beta stocks and into those less volatile sectors such as utilities, staples, healthcare, and real estate. This rotation can be seen as it is reflected in the rising price of those investments. The opposite, of course, is true too. When fear is waning, investors jump out of those safer investments and pile into those with more risk. This is just one example and reason why rotation occurs. There are many. The fact is, rotation is constantly occurring. Interestingly, and why I wanted to cover it now, it is exactly what has happened this quarter. As you can see in May's U.S. sector performance chart, the big gainers were staples, healthcare, utilities, and real estate. Those were the places to be as money flowed in, driving prices higher. 1 month later, June's U.S. sector biggest losers were communications, staples, utilities, and real estate, making that very wise decision you made in May to reduce risk in your portfolio look like a bad decision. I've researched rotation extensively in an attempt to find a way to profit and, unfortunately, have never found a way to capitalize. So today, for me, rotation is nothing more than just an understanding of what's going on underneath the market's hood, but after it's all occurred. As we close out the quarter, though, the rotation that occurred is signaling that investors' appetite risk is back. Now, let's go to my normal round-the-world stock view with some additional focus here in the U.S. and see if their messages match what occurred in the U.S. sectors. Starting off in Europe, we can see the stock ETF proxy, while still below prior highs, has made its first higher high and higher low from its 25+% correction. Price now is above both the 50 and 200-day moving averages, which is exactly how new uptrends must first begin. All that is needed now to confirm a new uptrend is price to go on to make a new higher high. In spite of the constructive possibilities, looking at the bottom pane of the ratio of U.S. stock market returns as compared to Europe's, it should be very clear the strongly downward sloping lines message is screaming there's no need to move investment capital out of the U.S. and into Europe. At least not yet. Next up, the emerging markets tell a similar tale to Europe. This is no surprise since the emerging markets' biggest trading partner is Europe. As Europe goes, so goes the emerging markets. The only one faint glimmer of hope that has my attention is shown in the lower pane of the stock market performance ratio of the U.S. to the emerging markets. You can see it may have ended its underperformance. I say may because, as of now, it has not yet created a lower low. A lower low would confirm a continuation of the ongoing downtrend. The possibility is still open. The ratio reverses immediately and begins to trend higher. But it needs to happen now. Otherwise, like Europe, there is no need to invest in this market since U.S. stocks would be the more compelling investment. Jumping over to developed Asia, the message is the same. One might be asking how these charts are indicating investors' increased appetite for risk. The key is that prices rallied off the low and made a new high, an interim high. Yes, that new high is lower than the previous one, so until it breaks above it, the market is not a compelling investment. But it has had a shallow pullback and attempting to create another new interim high. That new high would then confirm at least a new uptrend has begun. My investment approach is to avoid committing investment capital into things that are in a downtrend. All three of these regions we have looked at so far are attempting to signal a new uptrend has begun. Yes, it may seem as if I'm jumping to a conclusion, but I'm not. I am just gathering the weight of the evidence which says we are this close around the world, excluding the U.S. markets, to beginning new equity uptrends. Circling back to the U.S., the first chart to look at is the Dow Jones Industrials Index, a basket of 30 of the largest capitalized stocks in the U.S. market. As you can see, it is in way better shape than the other three regions we just looked at. Notice that price sits under this critical level, which has been tested 3 times before, now attempting number 4. This is very bullish because the more times price tests a level, the higher the probability it breaks through. U.S. small cap stocks aren't in an advanced state of bullishness as the rest of the U.S. market is, as they sit well below their prior highs. What is interesting about this scenario, though, is a recent study showed that historically, when small cap stocks are underperforming the broader market, and the broader market is attempting to break out to new highs, 100% of the times that it occurred in the past resulted in higher future stock prices. The results of this study came as a complete shock to me as it went against everything I was taught. To get a gauge of investors' desire for risk, one of the best proxies are momentum stocks. When the broad market is rising, momentum stocks are rising more. When the broad market is falling, momentum stocks are typically crashing. Looking at the proxy I use for momentum stocks, like industrials, they're knocking on heaven's door, on the cusp of a breakout. I don't need to say it, but momentum stocks approaching or making new highs don't occur in bear markets. It just doesn't happen. Let's end the look at U.S. stocks with a chart of the S&P 500 stock index, the 500 largest capitalized companies, and the normal proxy used to encapsulate the U.S. stock market. This is an incredibly bullish chart. Price is attempting to move above this important resistance zone that if failed to achieve twice before. A breakout to new highs is a signal we have begun a new uptrend. Risk is on and adjust your portfolio accordingly. Price is above the bullishly aligned moving averages. The only one knock I have, besides not yet making new highs, is that the 200-day moving average here is flattish. I'd prefer to see it upsloping. But if prices continue to rise, the 200-day moving average will catch up and soon point north. Before I move on to my final charts, I want to clarify something. Some of you probably read or heard the market made a new high on last Friday, the end of the month and quarters close. But my charts don't reflect that high. What's going on and who's right? Well, we both are. When I look at a chart, I pay attention to price and price only. I filter out everything else. If you include the dividends in the price of the S&P 500 index, which is how the media outlets report, then price absolutely made a new high, as you can see in my next chart. This is not about one way being right and the other wrong. It's nothing more than a different way to look at the same data. Either way you prefer to view it, the message is still the same. Stocks look higher from here. My next to last chart is that of the U.S. Treasury yield spread. The ramifications of an inverted yield curve has been written about extensively, including a blog post I wrote some weeks past. Bottom line is that an inverted yield curve is a precursor, a warning flag to the possibility of an upcoming recession. I won't waste any time here going into depth, but when looking at the yield spread, which is nothing more than the difference between the 10-year U.S. Treasury yield minus the 2-year, an inverted yield curve would be when the spread goes below zero. As you can see in the chart of the spread, we came so close to an inversion, but didn't quite make it and have definitely not stayed there long if we did. Instead, we have reversed course, the spread growing while the yield curve is rising. In case you're wondering, a rising yield curve is usually the sign of economic expansion and when stocks perform their best. My last chart is that of gold. I wrote a blog post about the breakout. Apparently, so did everybody else. The following day, I took a position in clients' accounts. In spite of so many false starts during the past 7-year downtrend, the setup and risk reward were too compelling not to. The good news is, if it turns out to be another head fake, the risk is very small due to an ideal entry point. If not, and at a minimum, this should provide a decent 15% upside trade. Best case, a new bull market has occurred and we're likely going to be adding to the position. Looking at the weight of the evidence of the charts, I don't know what you see, but it's strongly suggesting to me that we've entered a new risk asset uptrend. With clients' accounts currently at allocation, if we get follow through confirming new highs, whether they be all-time highs in the US or interim highs around the world, you should expect we'll be adding additional risk to clients' accounts soon thereafter. All that said, and as good as the setup is, I have to admit, It just doesn't smell right. I was taught to never act based upon what happened at the end of a quarter, as there's just too much window dressing going on to allow you to see the real story. Add to that, we're in the middle of the summer doldrums, when the large institutional managers are away, leaving the children in charge. But it's never a good time, and as risk managers, we'll always have doubts, but that's what makes the market, and why you need to have a set of rules or models to follow. And because ours triggered, we're going to follow. Of course, it's going to be begrudgingly. Well, that's it for now. Thanks for listening, and as always, I appreciate your time and your attention, and hope you found this video informative and helpful. If you have any special requests for the next installment or comments, I'd love to hear from you. You can send me an email at chuck@financialperspectives.biz. Again, thanks for listening, and until next quarter, this has been Chuck Gibson from Financial Perspectives with Q2 2019's Charts on the Move.